Good day, everyone. We are continuing our series here at SharpTrade.com regarding money management for investing and trading. This next principle that we're going to deal with is widely known but greatly misunderstood. Now remember, we are dealing with a series of trades, right? So you have 20 or 30 or 40 trades in one particular methodology. Not mixing up methodologies, but one particular methodology, 20 trades, 30 trades, 40 trades, 50 trades. That's what money management concerns itself with. Absolutely vital to understand. If you don't understand money management, then there's no profitable trading. It's just as simple as that. So, we have this next principle, and this next principle and when you look at a series of trades, is widely known, as we said, but wildly misunderstood and misused. I would even say it's misused. You know, you can have a butter knife, right? So you have a butter knife, and the purpose of a butter knife is to, spread oils, spread butter, spread some sort of spread on bread, things like, right? We all know what a butter knife's for. That's what a butter knife's for. However, sometimes you get a Phillips head screw, and because this is just handy and everybody knows about a butter knife, people will try to take the butter knife, stick it in the Phillips head screw, and try and, get that screw out or screw it in, right? That's not the purpose of this tool. And misunderstanding the purpose of a butter knife, you can end up stripping your screw. This is a Phillips head screwdriver. This is what you'll use for such a screw, right? It's the right tool for the right job. And you understand that if you've got a Phillips head screw, you better be using a screwdriver. Now, why are we talking about, butter knives and screwdrivers? Because accuracy rate, or your hit rate, it's much the same in trading. In other words, everybody knows about a butter knife, right? Everybody knows about accuracy rates, hit rates, and that's all they talk about. And they apply it to trading, just like trying to use a butter knife to get out a screw. You'll strip the screw. If all you do is apply your accuracy rate to trading, like how accurate are you, or what's your hit rate like, if that's all you focus in on, you're going to strip your trading account straight down to nothing. I mean, how many times have you seen it advertised or flouted, 80% accuracy rate, 85% accuracy rate, 95% accurate on our calls, accurate on our predictions. Who cares? That's not what profitable trading is about. It's one piece. Knowing your accuracy rate is important, right? You got that screw, you want to screw it in. Use the tool, use accuracy rate, use your hit rate in the correct manner. Use a screwdriver. Don't use a butter knife. This is for buttering bread. This is for screws. So when we look at an accuracy rate, how can you properly apply an accuracy rate to a series of trades? This next part is vital. Absolutely vital. So we've been talking for a little bit, but seriously, zero in on this next part. You have to know your accuracy rate. How accurate are you? But your accuracy rate is directly tied to what we have already discussed in this series. It is tied to your risk-reward ratio. Whatever your risk-reward ratio ends up being, how accurate you are, your hit rate, ties to your risk-reward ratio. You can have a profitable, wildly profitable trader who is only 60% accurate, but he's got a really good risk-reward ratio. 60% accurate with a risk-reward ratio of like 1 risk to 1.5 reward, that's making money. Period. That's printing money, as a matter of fact. He's wrong 40% of the time. Conversely, you can be right and just, I just got to be right. I just got to be accurate. You can be right 85, 90% of the time, and you will consistently lose money and you will consistently bleed out your account. Let's illustrate this.
Now, this is going to be a very quick, down and dirty illustration between two different traders, but remember, it's simply to illustrate a principle, and it's simply to illustrate the very, very beginning principles of money management over a series of trades. So we're going to look at two different traders, Trader A and Trader B. As we were saying earlier in this video, Trader A is 60% accurate. He has a 1 risk to 1.5 risk-reward ratio. Trader B just bought into all of the hype. 85% accurate, 85% accurate, 85% accurate. There's never any mention of how that accuracy rate on a single methodology that is tied to that accuracy rate has anything to do with the risk-reward ratio. So we look at that first trader, Trader A, starts off right off the bat with a couple of losses. Again, we're simplifying the dollar and cents amounts simply to illustrate the principle. We are not saying that all of the losses will be equal, right? We're just making the numerical amounts simple to illustrate the point. Obviously, over a series of trades, your losses may be a little bit less, they may be a little bit more, but we're just speaking on average, right? We're taking the risk-reward principle to illustrate how this works out. So we're just using a set amount for the loss rather than averages in the way it actually works out. But it's to illustrate that point. So anyways, Trader A, he starts off with a $1 loss, and then he has another $1 loss. Again, these number amounts are simple, just to keep it clear in your head. Then he has a win, another loss. Oh man, so at this point, you know, he's losing more often, we should say, than he wins. But if you follow that down, his total wins are about $9. He gives $4 back to the market. His profit is very obviously $5, right? Doesn't take a great degree of mathematical homework to understand that. Now, this is what typically happens with Trader B, and folks that sort of fall into this mindset of got to be accurate, more accurate. How can I be more accurate? Is what they do is they'll just win these tiny, tiny amounts. They do not allow their winning trades to run. So where Trader Trader A, you look at that first trade he took a loss. That very same trade, Trader B will say, ha ha ha, boy, do you need to learn trading? You lost a buck, I gained 21 cents. Same thing happens on trade 2. That's why you can't focus on individual trades. And a lot of new retail, just very newbie outlook is, am I going to be right or wrong on this trade? Who cares if you're right or wrong on this trade? But trade number 2, you look at Trader A, he lost a buck again. And Trader B is sitting there saying, oh man, Trader A, I might need to give you some lessons. You know, I won on that trade. Again, just focusing in on these single trades rather than the process. Do you see how new traders will just focus in on one trade and am I right or am I wrong? But you see what happens with Trader B. There's no thought to a risk-reward ratio. Generally, folks that fall into the Trader B camp, they do not like to accept a loss. They will do anything to avoid it. And so what ends up happening is they'll get themselves in a situation like trade 7 there. Oh, it'll turn around, because they want the psychological satisfaction of feeling a win. If that's what they're after, then they don't want to take the pain of a loss until it's too late and the loss just becomes too heavy and they have to accept the loss. And you see what the result is. Now, we said 85% accurate with no thought to risk-reward ratio. We used 85% to illustrate that you can't tell anything from just 10 trades. You would need to see like 100 trades, 50 trades. You know, you need to see a lot bigger of a data set. So that's why we picked 85%. But obviously, if we pick 10 trades, we can't say what's the half trade, right? So We just said 9 wins, 1 loss. But you see the pattern. You see the principle in action. The guy who only had a 60% accuracy rate was actually net profitable. Trader B, with a higher accuracy rate, is operating at a loss. And there's a lot of psychological reasons as to why that happens. They want the win so bad, they grab the wins too fast. They don't have some objective measure for letting a trade just go. They just want to grab that money because that just psychologically feels good to grab a winning trade. But inevitably, everybody will run into that losing trade. And that's where they get messed up. And they only focus on these single individual trades, and they're not keeping track of the entire process. They only focus on this trade or that trade. So in other words, what we're saying is that Trader B will typically look at someone like Trader A and think, yeah, I may have lost $1.23 on that trade, but you've had consecutive trades where you lost more. You lost more on trade 1 and trade 2 than I lost in all of trade 7. And I'm only down 44 cents. So, it'll work out. It'll turn around. You'll see. But they're not keeping an eye on that overall process and what's happening to them mathematically with their accuracy rate and the risk-reward ratio. So once again, this is just general principles to keep in mind, and it is simply meant to illustrate that your accuracy rate by itself is just a tool. You have to understand it in the proper context. And the way you understand any accuracy rate, any hit rate, is to understand how that ties in with the greater context and the greater number of trades in regards to the trader's risk-reward ratio. Okay, so that is what we have for today in this money management series or playlist of videos we have here at Sharp Trade. And as always, that has been what it's always been. It's simply been our thoughts, not yours, for whatever the heck day it is. As always, stay safe, trade well, and remember that love doesn't cost a dime.